Tell us a little bit about what you're seeing out there, where the opportunities for you, given you started your product, and then also tell us whether or not insurance has also had an impact on your fundraising.
I'm the founder and managing partner at Indago Capital. We started in 2023, and my background prior to this was I ran the structured products business globally at 𝐞𝐲. So just as how we look at the opportunity set, private credit is a broad term, but from an allocator perspective, where the market first developed was really more on the corporate direct lending side. Asset-based finance market is today, I think, where the corporate direct lending market was maybe 5 to 7 years ago, where it's still a fairly niche space. You do need specialized expertise, and it's a smaller number of players that can attack that market. Why I wanted to start Indago was we saw an opportunity, especially in the middle markets within asset-based finance, where as some of these transaction sizes get bigger, whether it's the large Blue Owl deal or some of the larger transactions, the minute that you can take some of these assets and then securitize them in the securities market, or very often now, a big theme that we'll talk about today is insurance capital. What has been driving the market to a large extent is taking, whether it's pools of consumer loans, pools of mortgages, and fitting them into insurance company balance sheets in fairly capital efficient manners. That's really been the driving force of the market. Where we think we have a unique advantage, or where we're focused, is in the middle markets, defined as the part of the market where the aggregate assets are less than a couple of $100 million in size, maybe similar to some of the niche strategies that JC talked about. And as soon as you look at that segment of the market, the capital that a lot of these specialty finance businesses have available to them is just a lot less efficient. Those assets typically can't be securitized, can't be put into insurance company balance sheets, largely on account of size. We sit in the middle of both insurance capital and more opportunistic capital. Our seed investor is a domestically licensed life and annuities player in the US. And as a part of that transaction, we manage long-dated capital for them across 2 different mandates. One of them is similar to the Exonic insurance business, where we're generally looking at higher up the capital structure, predominantly investment grade type risk. And then that sits alongside our more opportunistic credit vehicles. I think what that really creates for us is it gives us a breadth of capital with which we can provide solutions to our specialty finance counterparts up and down the capital structure. That does create a sourcing advantage, and really what we're looking to compete on is just ease of execution, certainty of execution, flexibility of capital, being able to provide solutions up and down the capital structure. Our remit's pretty broad. So while we just focus within asset-based finance, it's a huge market. The total outstanding, depending on how you measure it, is about 10 trillion. And within that, there's a lot of sub-asset types. So there's mortgage finance, both residential and commercial mortgages, various forms of consumer finance, and unsecured consumer lending, credit cards, student loans, autos, parts of the business finance universe, both small business and then the broadly syndicated CLO market, and then other specialty finance assets like equipment leasing. So we look across this breadth of underlying asset types and look to move capital to where we think the more interesting opportunities exist. And again, given the breadth of the underlying universe, there's a lot of cycles and many cycles that create specific opportunities at different points in time.
In terms of the conversations you're having when perhaps you're raising from a traditional allocator like Rich versus an insurance provider?
Yeah, I'd say the biggest focus from the insurance side is to maximize the return per unit of risk-based capital. And so very often for insurance businesses, you do tend to run them at a significant cushion versus the required regulatory capital. As we're looking to raise capital, whether it's managing for our investment grade sleeve or for the opportunity fund, the idea really is how do we structure these underlying investments to make them capital efficient from an insurance company balance sheet perspective. I'll give you a couple of examples on both sides. So the investment grade SMA that we manage, it is fairly capital efficient for insurance companies to just own whole mortgage loans, whether it's residential or commercial, because they are generally secured by real estate. There are a number of mortgage loan-related strategies that do fit that side of the bucket, and typically the return threshold that they're looking for tends to be somewhere in the SOFR plus 300 to 400 type range. Alongside that, there's a number of other private credit type facilities that we very often work with the rating agencies to get them rated. So again, they can fit the insurance company balance sheet. On the opportunity fund, a big emerging area for a number of credit managers, the general mechanism for an insurance company to participate, they can participate directly, but there is also a rated feeder structure where instead of owning the underlying fund interest directly on the insurance company balance sheet, that fund interest can be contributed to a special purpose vehicle that then issues notes, the majority of which can be rated investment grade. And that really owning the underlying notes gives them the same look-through exposure to the underlying funds, except they're owning it in a lot more capital-efficient manner.
Sure. One of my pet peeves when I meet with allocators that are not investing in private credit yet is somebody on the committee or a consultant will say something like, well, we need an expected return of X and private credit doesn't offer that expected return. First, that generalizes about a huge range of sub-asset classes, but it also ignores that bottom tranche of a rated note structure where everything that's not investment grade or flowing through as investment grade, all the initial cash flows is left. And that's got a huge expected return to it and diversification potential that meets the needs of opportunistic investors that have equity like or above expected return premium. So if you take one thing away from this panel, I'd say it's that private credit is not one size fits all. And if you hear a generalist statement about private credit, you should get allergic and get a different advisor.
And if I can just add to that, I feel you, because that's what we do every day. So there's a number of things one can do to tailor returns. One is through structure, which Akhil articulated quite well. And the other really is through bespoke solutions based on client needs, because there's a dearth of capital to certain borrowers, both in the middle market space to smaller businesses. If you're talking about borrowers with $50 to $100 million in revenues, for example, on the company side, we have a company ABL business. We're able to get security on cash, accounts receivable, inventory, all the assets of the company, sometimes with guarantees from the equity, sometimes with PGs from the founders, believe it or not, mid-teens, which is, it's pretty good given the underwriting we do. And we're even able in those situations to get control agreements and have real-time monitoring of bank accounts with account control, with DACAs and all sorts of bells and whistles. And that's really because of the dearth of capital in that space. Given the sort of voracious appetite for LPs and, frankly, sponsors or founders with restricted shares, we're able to tailor bespoke solutions that really serve their needs in terms of duration. We might pick for a little while if they have a liquidity need and they know they're going to get a distribution at a certain period of time. So I think you can also get excess return in private credit, to your point, Rich, because one size does not fit all. And I imagine both JC and Akhil are doing the same thing here. By tailoring the solution to the borrower's need, you can get excess return that you really can't see in the public market.